So welcome to this video. In this video, we are going to solve an NPV problem. And this question was asked in June 2016. And this question has like two requirements. So one is calculate the expected NPV of the investment for the first 4 years of operation. And thereafter, they are asking you another requirement. Okay, so B we will see later. And we'll start with the question here. So we'll read the question. So Degnesco is a company which installs kitchens. It is planning to invest 4 million in a new facility to convert vans and trucks into motor houses. Each motor home will be designed and built according to customer requirements. Degnesco expects motor home production and sales in the first 4 years of operation to be as follows. So this is going to be the production and sales for the 4 years of operation. The selling price for a motorhome depends on the van or truck which is converted, the quality of the units installed, and the extent of conversion work required. Degnesco has undertaken research into the likely sales and costs of different kinds of motorhomes, which could be selected by customers are as follows. So they are not sure about which product will be like selected by the customer. So there are like three types of models that the company has: basic, standard, and deluxe. And this is what the probability of sales will be. So 20%, 45%, and 35%. And the selling price per unit is given here. The conversion cost, which should be the variable cost, because it's like conversion cost per unit. So if it is like in per unit, it is a variable cost. So that is also given. Fixed cost of the production facility are expected to depend on the volume of motorhome production as follows. So the fixed cost is depending upon how many units are sold. So they have given a range, and they have also given the fixed cost for each range. And Degnesco pays corporation tax of 28% per year, with tax liability being settled in the year in which it arises. So there's no arrear years. Okay, the company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. Degnesco evaluates investment projects using an after-tax discount rate of 11%. So we'll start it from here. So we'll have it as requirement A, and we'll start from particulars. So we'll do the problem in terms of thousands. Okay, so we'll have a working notes here to be referred, and we'll start from the 0th year. 1, 2, 3, and 4 is the 4 years is the operation. So they have given it in the 4 years of operation. So we don't need to have the 5th year because tax is not in arrears. Tax is paid in the year in which it arises. So no 5th year is required. So the first number that we have to have is sales number. But if we work out sales number, it takes a long time to find out the sales number, then variable cost number, and then like finding out the other relevant numbers. Better what we'll do working notes here. So we'll start from working notes. Okay, so the first working note, we'll take it as the total contribution. So first we'll calculate the total contribution. So to calculate the contribution, first we have to find out the sales and the variable cost. And sales and the variable cost. So this will give us the contribution. But the data that has been given, is contribution per unit. So the answer that we'll get is also will be in a units. So we have three types of products: basic, standard, and deluxe. So the sales value here is, we'll cut the thousands, so it's 30 here. 23 is the variable cost. Here it's going to be 42. 29 is the variable cost, and the deluxe is 72 is the selling price, and variable cost is going to be 40. Okay, so as these are negative numbers, we can take them as negative symbol. We can take them in negative symbols. Okay, so now we can just add these two numbers. So we can just add the other numbers too. So we have got our contribution per unit. So we have a probability here that has been given. So probability is 0.2, either 20% or 0.2 you can take. I'll take it as 0.2, 0.45 and 0.35. Okay, so we've got the numbers. So now we'll try to get the contribution. We'll try to get the contribution per unit into the probability that we'll try to multiply. So we'll finish it in one single sentence like this, or we can just multiply it. So we'll do it for all the numbers. Okay, so now you will get the total contribution. So now you will get the total contribution here, and that would be an addition of all these numbers. So sum. So it's 18.45, and take it as per unit. It is still in per unit. Okay, so this number we can get it for the years. So in terms of years, we can put it like this. For the first year, we have a sales of 250 units multiply by the contribution per unit, that is 18.45. So we got the answer. So in similar way, for the second year, it's like quite easy from here on. We can take these numbers and we can take it off. So we have to just change the sales units. So that's going to be 300 into 18.45. Thereafter, it's going to be 450. It's going to be 450 into 18.45, and the last number is also the same number. Okay, so we can just simply multiply that and we got the answers. So this number would be our total contribution. So we can have it here. So this is referred in working note 1. Okay, so we'll go to the next one. So the next one is fixed cost. So we'll have it as fixed cost. Fixed cost is in a range, so we have to work out in a range and we have to find it out. So when we produce 250 units, the fixed cost is going to be in 4,000. See, already thousands has been like it is already in thousands only. So we have to take the 4,000 directly and we have to take it. So the next number would be 300 units. For 300, it is 5,000 fixed cost. And for 450 units, it's going to be 5,500 fixed cost. And for again 450 units, it's the same 5,500 fixed cost. So we can directly take it like this. So once we have done, we will be like getting the profit before tax. So profit before tax is simply like add both the numbers. You'll get the answer. So you will get the answer now. So from here on, you have to compute the tax. So tax is at 28%. So tax is at 28%. So, and it is also payable in the same year. So that's what they say, with the tax liability being settled in the year in which it is arises. So you can take this number and multiply by 28%. You will get the answer. But as it is a negative number, you can take it as a minus symbol. So you got the answer. Now the same approach you have to do it for other years. But in this sum, you have a tax allowable depreciation. So for that, we have to do a working note. So the working note, we'll do it here. So it is tax allowable depreciation. So we'll do it here. So we have to read the data for it. The company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. So the depreciation we have to calculate first, depreciation per annum. So depreciation per annum works like this. We have to find out what's the cost of the investment. So the cost of the investment is 4,000 minus if there's any scrap value. There's no scrap value in this problem, so it should be 0. And this has to be solved in a bracket. And then divided by the number of years. Number of years is 10 years. So this will give you the depreciation. So I'll work it out here. So the answer would be, okay, so we got the answer. So depreciation is 400 per annum. So what would be the tax benefit? The tax is at 28%. So this number into 28%, we'll get the answer. But this is a positive number because it's an inflow. So it is 28%. So we get 112. So this 112 will occur for how many years? 112 will occur for 10 years. Okay, but we are going to compute the problem itself only for 4 years, so we don't need to take it for 10 years. So we'll take it as 112 for the each year. Okay, we'll take for each year. So we got our profit after tax. So profit after tax is simply a sum again. So sum, how many numbers we have? Profit before tax to tax allowable depreciation. We add all the numbers. We got all the numbers and we put them together. So we got our profit after tax. So the next number that we have to compute is the purchase cost, scrap value, and working capital. There's no working capital here, and there's no resale value or scrap value. The only thing that we have is the investment cost. So the investment cost is done on the first year, which is 4,000. So we have done all the numbers. We'll get the cash flow. So the cash flow would come to, again we'll do a sum. This is not required. If you want, you can do it. And if you don't do this step, you will still get the answer, right? But for neatness, we'll do this. Then we'll have to find out the discount factor at 11%. So for the 0th year, it will always be 1. For the first year, it will be 1 divided by 1.11. So take that and do it for the rest of 4 years. So the next step is we'll find out the DCF. So DCF is just a multiplication from cash flow into the discount factor, and do it for 4 years. You got it. And finally add them together. You will get your NPV. You will get your NPV. So NPV will be from here to here. You close the bracket. So answer comes to minus 138. So that is the correct answer. It's a negative. So the suggestion would be As NPV is negative, the project should be rejected. So that's about the suggestion. So we have our working notes here. Okay, so our table is very clean. We are also having the working notes here, which is also like cleanly kept, and it's like understandable. We also done the tax allowable depreciation part. If you want, you can highlight certain parts. So what we'll do is we'll highlight the headings. Okay, and have we finished this problem? The answer is no. We still have one more element. So we'll start from the requirement B. So the requirement B, if you look at, after the fourth year of operation, Degnisco expects to continue to produce and sell 450 motor homes per year for the foreseeable future. Calculate the effect on the expected net present value of the planned investment of continuing to produce and sell motor homes beyond the first 4 years and comment on the financial acceptability of the planned investment. So what they are asking you is the perpetuity. So perpetuity has a formula. So the formula works like this. It's annual cash inflow divided by the rate So normally what happens is once you have the cash inflow, you can divide it by the rate, which the rate can be a discount factor. So we will go to our question here and we'll try to find out what happens. The requirement is after the fourth year, the cash flow also continues for as a perpetuity. So we'll copy the table as it is and we'll have only the relevant numbers that we want. So the relevant numbers that we want are the profit before tax that is going to occur, the tax that is going to occur, the tax allowable depreciation. As of now, we'll delete it and we'll explain why it is being deleted later. So we should be like having the, so we will calculate the tax, profit after tax. So we don't need other numbers here. We can delete the other numbers. So what we require here is the profit after tax, and not that too for all the years. We just want it for the fourth year alone. So we'll just take the fourth year numbers and we will put it here. Okay. So what is the profit after tax? The profit after tax is the addition of two numbers, the profit before tax and the tax. So the answer comes to 2018. So this 2018 is going to come on a recurring basis for a foreseeable future. So if we want to find out a foreseeable future, then we have to find out the perpetuity. So this 2018 is an perpetuity, is an perpetual cash flow. So it's going to keep on coming. So we have to find out what's the value of it. So we'll put it here. Value of perpetuity at fourth year end. So what happens is this value 2018 divided by 0.11 is for the fourth year end. We are not concerned about what's the value in the fourth year end, but what is the value of the perpetuity today. Okay, so we don't need the other numbers. So how do you compute the value of perpetuity today? It's computed based upon the today's value. The discount factor, which is for the fourth year, is 0.658. So take that value. So this perpetuity is going to occur at the end of the fourth year. So you can multiply this into the discount factor for the fourth year. That is going to be 0.658. 2.658. So we'll just check once. So this is going to be the value of perpetuity today. But this alone is not the perpetuity, because we have a tax allowable depreciation that is going to occur for 6 years, at 11%. So it is going to occur for 6% at 6 years at 11%. So that we have to calculate. So we'll calculate that. So the value would be 112, which is a tax allowable depreciation. So if you check here, that is the tax allowable depreciation, and this value is going to occur for 6 years. Okay, from which year? The year is from the 5th year to the 10th year. Okay, from 6th year to the 10th year it is going to occur. So how do you find out the discount factor? The discount factor would be you take the same 4th year last discount factor, you copy and you paste. The formula has already been inbuilt, so you get the discount factor of each year. When you add all of this, you get the annuity factor for 5 to 10 years, at 11%. So how do we get that value? We just add them from here to the end, we add them. So we got the number. Yes, we got a number 2.786. So take that number. This should be 2.786, and the cash flow was 112. So we'll release this. So what would be the present value of TAD for 6 years? So multiply both. Every year we get 112 for 6 years. From the 5th to the 6th year, if we get that value put together, would be 312. So this number has to be added with the total value of perpetuity. So total value of perpetuity. So in this perpetuity we are going to get two values. We're going to get two values. So the values are, one is this number, okay, and two is the tax allowable depreciation for 6 years, both together. So this would be our total value of perpetuity. Okay, so now he asks you whether we will go ahead with the investment. The answer is yes. Suggestion would be as the NPV is positive after adding the perpetuity, we can accept the project. So that's about the concept. So how do we know whether the NP would be positive? Because NP was earlier negative by 138 and the perpetuity is like 12,000. So when you add both, it actually goes much higher. So that's why we have given this suggestion. So that's about this problem. So if you want to make it neat, you can make it neat. Okay, so we have bolded it at several places. So that's it. We have come to the end of the problem. Thank you for watching. We'll meet in the next video.